Carolyn, welcome to Ten Across Conversations. Thank you for joining us to talk about a complex issue, insurance.
Thanks for having me. Looking forward to it.
We are too, because this is a topic that's come up in many Ten Across conversations, whether it's with our private sector partners, people in public administrations, or just civic leaders trying to navigate certain questions. So it's a privilege to have an expert like yourself. Can you talk a little bit about your background? Because you've been involved in environmental issues, risk issues involving insurance. You've been in academia, in public administrations, a really great and varied background. Describe how it adds up to being interested in insurance.
Yeah, good question. I was just recently at a conference last week, and you often hear this thing said about insurance, which is that people fall accidentally into insurance. Nobody sets out to work on insurance. That sort of happened to me, but I actually think that's changing. As all these conversations are now being had, I'm talking to lots of students who are really interested in this topic. So I think climate change is altering that perception of the insurance industry. But I did sort of accidentally stumble upon insurance when I was doing my dissertation work. I had been looking at ecosystems and the benefits that humans get from natural environments and what types of economic and policy tools we could use to support that. And that was when Hurricane Katrina hit New Orleans. And I got pulled into a project that was looking at the role of coastal wetlands in buffering storm surge because I'd been interested in this role that natural systems can play. But through that work, I started tracking really closely what happened during that storm, the challenges with recovery, how long recovery took. And that's how I stumbled into insurance and just got really fascinated with how we manage catastrophic risks. Sometimes manage them poorly, sometimes manage them well, and what it means to do that better.
You know, it's interesting that Katrina is a common denominator among many of our guests. It's what inspired Ten Across. I did my graduate work years before Katrina on what would happen in New Orleans when the hurricane finally hit the way that it did. But the things that we anticipated, unfortunately, came to pass, which is about risk. It's about insurance, right? So if you can understand something is a possibility, what do you do in advance to prepare for that? And so we had Mayor Landrieu on a podcast a month ago, which clearly he had to pick up a lot of the pieces from Katrina. So it's just interesting that such a pivotal event, and at that time was the most expensive in the country, is in so many people's backgrounds. I spent 10 years of my life in New Orleans as well.
Oh, well, you really know it all firsthand then. And I think you're right. I mean, it was such a disruptive event and so severe that I think it really woke up a lot of people to how we manage these types of extreme events. Absolutely.
And the urgency in the Gulf, when you can see land loss, needs to be distributed, which is why we started Ten Across to other parts of the country to understand the risks that they're confronting. So you mentioned you were at a conference and that students are taking an interest in this. I have often said that I think sometimes people think insurance is going to save us from doing the wrong things. It'll just be too expensive to do that. What kind of conferences and discussions do you have where an interest in, of all things, insurance is provoked?
Well, there's actually lots of events around insurance and climate right now. And those are taking a number of different forms. But I think what you said is exactly right. Insurance is not going to save us. Insurance is a really important tool that we need to start thinking about better. And I think there's kind of two pieces to that in my mind. One is that insurance underpins so much of our economic activity. There's so much we can't do without insurance, from taking out a mortgage to building infrastructure. And so in that way, it's a lever into many types of economic activities and sectors. But also we have all this good research on how critical it is to recovery from extreme events. And as climate is just increasing the frequency and severity of these weather-related extremes, that role becomes so much more important in providing that recovery. And yet that growing risk is also stressing insurance markets right when we need them the most. So it's become front and center, I think, in these many different ways.
And based on all those observations and your history, you've started something called Insurance for Good, which brings in, I think, an equity component to this, because many of the people who are suffering from the events that are catastrophic, as well as the inability maybe to secure insurance, are those who are least protected from both of those issues. Talk about Insurance for Good and how it came about.
Yeah, that's exactly right. So at Insurance for Good, we're trying to reimagine risk transfer as a force for social and environmental goods, and how can we handle it to meet these goals that we have. So we're designed to assist communities, the public sector, and regulators with learning about insurance and finding solutions that work. So we have kind of four big buckets of activity that we work on. The first is curating trusted and credible resources around these topics. The second is education and capacity building. As we were just talking about, there's so many new stakeholders to insurance conversations, and making sure they have the information they need to engage and get to the solutions that work. The third is around innovation. We have something called our Solutions Catalyst, where we partner to find new types of approaches that can solve particular unmet needs or insurance difficulties. And then the fourth is evidence-based policy and regulatory reform. And then across all four of those kind of buckets of activity, we have four key issue areas, which is how insurance interfaces with, as you said, creating more equitable recoveries and more inclusive insurance markets, driving more loss reduction and resilience and climate adaptation, whatever word you want to use for kind of lowering our risk. The third is the energy transition, and the fourth is nature positive approaches throughout the economy.
It's easy to move into discussions about what's currently going on in Washington, D.C. and these issues, but let's take number two that you just mentioned. Given that the EPA, even some indicators about coastal resilience, which we were talking about at the beginning of this conversation, some of those mechanisms are being reduced or made less accessible. How are you navigating the changing address to the adaptation issue while you're thinking about insurance? Because that is a moving target, one that's moving at pretty fast speed at the moment.
Yeah, absolutely. And just to kind of underline the relationship there, we were talking about these growing risks, and you can't financially engineer your way out of them. We're not going to insure our way out of all the climate risks that are coming our way, since we have failed to do the necessary scope and scale of decarbonization. And so doing the work of actually reducing those risks is really critical to maintaining insurability. So in order to have stable insurance markets where we can have thriving communities and stable housing and mortgage markets, we have to lower the risk. And so these investments in risk reduction that you're talking about that have become under threat in this administration, things like building protective infrastructure, stronger building codes, are all have this really tight link with insurance.
Right.
And I've been very concerned about I don't know how long we want to spend on what's going on federally, but with what's happening, we just saw recently this past week that a really important grant program in FEMA that was paying for some of these loss reduction measures in communities was taken away. The NOAA data is really critical to managing risks, like all these things. And so I think it's scary, because I think that if we pull back the data and information, if we pull back the federal resources, we're going to see higher losses, less safe communities, threats to life safety, and we're also going to see growing inequities, because there are states and localities that have the resources that will need to step in and will be able to continue to provide some of this risk reduction, but there are others that really don't without the federal help, and they're not going to be able to make the same level of investments.
Feel free to use words like scary, because I think they're appropriate for this. And
I do too.
It just, all the work that you're doing, it feels like it's being eroded by things that are controllable. These are not events that are suddenly happening in more frequent occurrences, which that is the case. These are just simply decisions being made, which make us more vulnerable. You talked about states and or localities that might have greater capacity to respond to that. So we built the 10 Across project knowing that it included, let's say, California, Louisiana, Florida, the states, Texas now, that have the most not only vulnerabilities, but are grappling with different insurance mechanisms to respond to them. So do you want to speak to this area and the differences between what Florida has done in a more deregulated mode, what California is doing? When you look at the combination of these, what do you see working? What do you not see working in these areas?
Yeah, that's a good question. And just in case you have listeners who don't realize, insurance is regulated at a state level. So we do see differences in the way insurance is managed across all the different U.S. jurisdictions. And the ones you mentioned are absolutely the ones right now that are really struggling with increasing risk and what it does to insurance markets. And we're getting to geographic pockets where it's essentially becoming too difficult for insurers to continue to write coverage either at all or at a price that people are willing and able to pay. And, there's a line in the insurance industry that anything's insurable, it's just the price. Well,
Right.
if people can't pay the price, your market is broken down. And then that's a different kind of uninsurability, right? And so certainly Southern Louisiana, Southern Florida, parts of California are like this. You really can't get insurance coverage from the private market anymore. And all three, well, actually, everywhere across your region has a state created market of last resort. And those they have some similarities and they have some differences. And how they operate and how they interact with the private market, I think, can vary. In Florida, as you said, they've been struggling with this going back to at least Hurricane Andrew in 1992, and their relationship to the industry and their state program called Florida Citizens has really seen significant ups and downs, where they've gone through periods where they sort of treated that state program as a market of first resort, and they made it easy to get that policy and cheaper than the private market. And then realized how much risk that put on them and pulled back and made it a lot harder to move into the market of last resort. And so you see these kind of dynamics playing out. Across all of the states, this is not a red-blue issue. This is like a people issue. We don't want expensive insurance. Nobody wants expensive insurance. And so there's always this pressure to do things that will keep costs lower in the short term. But then the cost of risk have to be paid eventually. So that's what you're seeing. This is the same thing in Florida as in California. When those state programs don't have enough funds, they have to go into assessments on broader policyholders and that type of thing.
It's really interesting. And I guess I understand why it came to be this way, that insurance is bounded by states. State boundaries, they each have a different way of approaching this. There's a group of folks on the Mississippi River, which we've looked at because it's comparable to our linear organization, but they're all attached to the river in some way, and thus there's some commonality there. But trying to build, let's say, a risk pool or respond to something that they're all grappling with, which is not about state boundaries. It's about something that at times when the Mississippi River overflows and floods, they've all experienced. And could they get together and think holistically or collectively about a response to that? So can you talk about that strategy and ways of maybe overcoming state boundaries as we think about insurance?
So at a high level, there are many firms that operate in lots of states, right? The big name insurance companies operate throughout the country. They have to interface with all these regulators. And there is some effort to kind of coordinate and make that easier on insurance companies through the National Association of Insurance Commissioners. And so there's some attempt to do that. For these types of new innovative solutions, like you're mentioning with the Mississippi system, it would require engaging with different regulators, right, to set up something like that. So on the one hand, maybe that can be a challenge. On the other hand, I don't see anything particularly different or should be more difficult for a firm that's operating in many states, right? And so I think some of the harder things for our current regulatory environment are not necessarily the cross-state nature of things, but we're seeing growing interest in types of mechanisms that act a lot like insurance, but regulators aren't quite sure are insurance. So I'm thinking about some of the parametric approaches that pay out based on just an observable measure of the hazard. But insurance is defined almost everywhere as indemnifying you for a loss. And so if there's a possibility of making a windfall, like because your payout's not directly connected to your economic loss, that's not insurance anymore, right? But you can design those to mimic insurance. So these are kind of regulatory questions that are bubbling up.
And for the audience, because it comes up, this word, explain parametric insurance, what that word means.
Yeah, so most of the insurance that people in the US are familiar with is referred to in the industry as indemnity insurance, which is like your homeowners, your health insurance. It pays the losses that you sustain. So if you have damage to your home, a person shows up, a loss adjuster, to look at that damage, and they might also want to see your receipts and all sorts of things to pay you just what was lost.
So an event has to happen for you to now engage the company and the benefits therein.
Yeah, and then how much you get paid is determined by how bad that loss is and what it costs to recover, subject to the terms and conditions of your policy, of course. And we can spend some time on those fine print that often really hurt consumers when they go to rebuild. But parametric is different. The idea is that you get a predefined amount of money based on an observable measure of the hazard. And so I think the easiest way to think about it that I tell people is wind speeds within so many miles of your house exceed a threshold, you'd get a set amount of money. So you can see that that can't replace something like a standard homeowner's policy when you really want to be covered for whatever loss you get. But it's a new tool that opens up an ability to have financial protection against a range of losses that we in the past haven't had good ways to protect people from. So things like non-property losses. What about when you lose income or a business loses revenue and when it's not maybe attached to damage that you sustain? So where you work gets damaged, you have no property damage, but you can't go to work and you lose your paycheck. Or, commercial entities have used this for a long time along the Gulf Coast, where if a hurricane comes and hits nearby and it scares all the tourists away, or there's a hurricane warning, even if it doesn't hit, you're a hotel, you might not have suffered property damage, but you lost a lot of revenue. So that's where parametric policy can be helpful. We've also seen it helpful throughout sort of the global South with lower income policyholders who need less dollars, but need fast dollars and flexible dollars to meet their emergency needs. And that's been really interesting to see in countries around the world. And it's just starting to come to the US market. Puerto Rico is the first jurisdiction to really stand up a microinsurance market against disaster risks. And there's now thousands of microinsurance policies in force on the island.
And there's also a group in the Caribbean that behaves in a way, in a collective manner, as I was just describing on the Mississippi. You want to explain that a little bit?
Yeah, that's an interesting model too. So a bunch of Caribbean countries, and I think now there's actually several Latin American countries in it too. I'd have to go check that. I think so. Have kind of come together and created this pool, and they're using parametric approaches at the level of a country. So a hurricane hits one of the countries, one of the islands, and they get an immediate infusion of dollars to help with recovery. And they've found that that type of parametric approach is really helpful for countries that couldn't absorb that magnitude of loss. And while waiting on international aid can take a long time or be poorly matched to their need. And so this type of financial mechanism, and I think, like the World Bank and other aid agencies have been involved in kind of standing it up, have enabled them to have a lot of sort of ownership and flexibility in that recovery. That the group, once you kind of bring people together in these risk pooling arrangements, they also do a lot on risk assessment and understanding the risks and data and how to manage them and lower your loss. So it's a really nice thing. We now, in addition to the Caribbean one, there's a similar pool like that in Africa and also one in the Pacific.
Mm-hmm. We've always imagined, could there possibly be a 10 across vehicle for thinking about this, but we can say
I love that idea. Yes.
Well, we really want to explore it because there clearly needs to be innovation, which you're all about in the work that you do. And I think at the beginning of this conversation, you talked about helping people through Insurance for Good design an insurance, let's call it a policy, that met their needs. I think people assume insurance is much like going retail shopping. What's on the shelf, you pick that or you pick that. You're just suggesting that there are ways of reinventing how we approach insurance and what you should be able to expect from that if designed differently. So I want to come back to that.
Well, I think it's a great idea. And I think that flexibility really opens up when you're like at the level of a community or a city. I mean, it is harder as just a one homeowner to redesign things. But if you think about creating a pool of cities or communities like the Caribbean, that gives you sort of market access to think more creatively. So
that was our thinking, but we're not in the business and we don't know it nearly like you do. But you just brought up where I wanted to go. So we've talked about national issues, even international, states, going down to the local level. And I know you care passionately about this with Insurance for Good. The inability of homeowners, an individual homeowner or a community, to get insurance because it's affordable or not, and a variety of other things that might be happening beyond their control. Companies pulling out. What describe, as if it isn't obvious, but I think it's useful from your perspective. What does it mean to a community to know that it's insurable and for homeowners to know that they have access to these products? We'll talk about their affordability in a minute, but just even the confidence that they have that they can find insurance.
Yeah, it's really important. And it's a question we're really actively grappling with right now. So I'm glad you asked it around what is an insurable community. And I think, in decades past, it was something we took for granted that we had
Mhm.
stable insurance markets and
Mhm.
access to insurance markets. And the fact that our climate is no longer stable and is kind of undermining that. What was so beneficial about insurance that we are now struggling with? And there's some growing research, myself and colleagues that have been doing on the role of insurance. And you see that it's not only financially protective for households, right? Households who are insured do better post-disaster. They have much better economic
Mhm.
outcomes. We see lack of insurance widens inequality, but we also have good evidence that as more people in a community have insurance, their local economy does better because they're able to more quickly and fully participate in the local economy. We see that it stabilizes housing markets, that it prevents against negative outcomes to lenders and the GSEs, so it stabilizes mortgage markets. So an
Mhm.
insurable community has, just like you were saying, all these benefits, not just to the people who live there, but to the local economy and to the adjacent markets. And so now we're in this world of, well, how do we get back to insurability? If we've gotten so risky that the insurers are starting to pull out and it's costing too much, what do we need to do? And this is a tough conversation that needs to unite a bunch of people who are now starting to talk to each other, but historically maybe didn't, right? This is land use and planning. This is building and architecture and
Mhm.
engineering. And yes, insurance and
Mhm.
funding and finance to do all those changes and gets to a lot of also just behavioral questions
Yeah.
too about how we feel about changing the way our communities look and feel. So I think it's the central question for
On,
the next few years.
on that last topic, that's why I said earlier, maybe insurance will save us from ourselves. If we just talk about these issues, where I'm allowed to live or build a house, oh, this is government telling me what to do. But when it's a, a determination has been achieved numerically, people assume insurance is that way. Well, I guess at that point, I really have to respond to it. I'm not being told by government what to do. It's simply a business matter. So that's interesting. But if I don't live in an area that has high risk, how is my insurance affected by what might be happening 1,000 miles away? What should I know about my insurance living maybe somewhere where risks would appear to be minimal?
So that's a good question, and it depends what state you're in. So
Yeah.
in general, I think people think my insurance reflects my risk. And
Hmm.
so if I'm in a low risk area, I'm going to have better insurance rates, and my rates are not dependent on the people living in high risk areas. And to a degree, that's true. But what we see is that in a lot of states, getting back to this thing that nobody likes high insurance, that there's been sometimes historically rate suppression by regulators, which is to say that the rates are closer together than the risk would indicate,
Hmm.
which means lower risk people are paying more so that higher risk people can pay less. In
Right.
states like Florida, Louisiana, California, where we're seeing growing numbers of people in the state market of last resort, that's actually even further formalized because all of those
Hmm.
programs are not designed to be able to pay catastrophic losses with money on hand. What they do in different ways, like we can take Florida as an example, when their state insurer, Florida Citizen, faces a severe loss year, they go to the bond market and take on debt, and they pay back that debt by assessing first their policyholders, but then for a big loss, every policyholder in the state. So big hurricane hits South Florida, you're an auto policy holder in North
Hmm.
Central Florida, you will
Hmm.
be facing fees to cover those losses. And so we're really cross subsidizing insurance prices in a number of places around the country.
And you also mentioned how insurance gets you into matters of planning. I'm a member of the Urban Land Institute and work a lot with them. They were
They're
there
great.
in post Katrina, they were there post fires in California, construction, architecture, all these other things. What might be the obligation or the interest of insurance companies, either insurance or reinsurance, of getting involved in things sort of outside their comfort zone? Matters in other sectors where if they were to either suggest things that would make places more insurable, they should be doing more of that, or maybe even going beyond that, doing something to make communities more resilient and even appropriately adaptive given climate change.
I would love to see insurance companies doing way more on this than they're currently doing. I'm like cautiously optimistic that's starting to change. There's been some narrow areas where we've seen a lot of insurer engagement. One is through the Institute for Building and Home Safety, which is an absolutely wonderful organization
Mm.
that's funded by the insurance industry, and they develop safety standards for building to disaster. So they have a hurricane standard, they have a wildfire standard. These are really great evidence-based construction techniques to make our homes
Hmm.
safer.
Hmm. Hmm.
If you Google them, it's really neat because they have this big facility where they literally like throw fire at fake buildings and like high winds, and you can kind of see how they react. And the insurers have been very supportive of that. That said, it usually takes a lot of, it takes regulatory push to make them reflect that in the pricing. There's still challenges in getting good data on loss
Mm.
reduction into insurer pricing and underwriting. And I think it's a conservative industry, and they've generally not weighed in on policy and political discussions. And I think that's too bad because we really need stronger building codes that are
Hmm.
forward looking with our climate changes. And communities, they come to us and they're asking for guidance. They want an insurable community. They want
Right.
safety and they need help. And who better than the insurance companies that have all the risk assessments? So I'm hoping we'll see more of that type of engagement in the future, but you're right. There hasn't been much yet.
Yeah. And do they, this assumes that they have the capacity. And just because insurance companies are large doesn't necessarily mean they should be picking up things well beyond their ability to address them appropriately. But you'd love to see a convergence of the private sector and the Building Resilient Infrastructure and Communities Grant Program under FEMA, which is now retreating. You'd love to see a convergence of government, private sector, and community input arriving, but that seems to be becoming more difficult. At the state level, where insurance is governed, I think California, Alabama, Louisiana have tried, I think, to cause benefits to accrue to those who are building more appropriately, having things put into building codes that would make places safer and more resilient to various challenges. Do you see more states asking for tougher criteria, if you will, for building in places that are difficult?
Yeah, I think we are seeing movement in that direction. Alabama, for example, as you probably know, is a really wonderful example of doing this really
Hmm.
well. Early on, they put together a sort of package of incentives and financing to support hurricane retrofits and rebuilding again to this IBHS standard. And so they have a grant program to support that at the state level. They require insurers to offer endorsements to their policy. And I think that their state market of last resort offers these for free, which is once you go to rebuild, if you have to replace your roof, you get the little bit of extra money to make sure it's a hurricane resistant roof.
Right.
And they adopted very strict building codes in their coastal communities. They've had great research done by some wonderful colleagues in Alabama showing that once you build to the safety standard, your home values go up. So
Yep.
they've also reached out to realtors and the community, and they understand the value of this. And you get this really positive feedback effect, right? Where people understand how beneficial it is. You see those beneficial outcomes in the different markets. And so I think we're seeing states now trying to replicate some of that. Louisiana has been trying to replicate it, for example, and get to that resilience reinforcing or something. I don't know.
Yeah.
Yeah.
Well, what's interesting, and again, I think this is why we picked this territory to build Tend Across on, because it was only 3 weeks ago we had a podcast with Catherine Coleman Flowers. Her concern, as you probably well know through her books, writings, and public addresses, has to do with the availability of proper sanitation in Alabama in certain counties. So, in a single state, you can have what you describe as an exemplary address to things like risk and hurricanes and building more sound roofs. And she's trying to address in Lowndes County just getting the basics of what you would expect from a home done to live safely in a sanitary condition. So, we just see such extremes in the
Yeah.
Tennessee region, and sometimes even in the same state. It's fascinating. I'm not sure how we address it all. Um,
Yeah. Well, I think it's a really good question, too. I mean, from the perspective of a resident, I think there's something really compelling about just thinking about what makes a safe, livable home for our climate future. And that's all the safety and sanitation issues. That's resilience against increasing risk. And that's also decarbonizing our building stock.
yeah,
And so how do we put all that together maybe in a comprehensive package of how we're building?
and this connects with something I know that you've worked on. where actuarial science has at times, or as you go back and look at it retrospectively, included issues of race and economics and who gets served and who doesn't properly, where you would think insurance is about pure risk. And sometimes it's about other things, which we know is true of infrastructure and the way the built environment is formed. Talk about how that crept into insurance and how that's been addressed.
Yeah, I mean, some of this goes back to like, redlining and
Hmm.
lending, and it definitely impacted insurance markets as well. We now see that most jurisdictions have in place regulations to prohibit price discrimination on certain factors that we believe as a society shouldn't be the basis for
Hmm.
changes in pricing. There is some research evidence though that sometimes it's happening maybe inadvertently, like that we still see correlations in insurance market outcomes between things like income or gender or whatever. And I think the questions are, what are the mechanisms there, right? And sometimes the mechanism is that higher risk is actually correlated with something like income. So to your earlier point, if you're lower income, you might also be in a house that's less safe and that's
Hmm.
not built to those higher standards. And so you're going to face higher insurance premiums because your home isn't as safe. And it's not because of discrimination based on income, but because of this tight correlation between income and being able to invest in safety. And I think understanding what those mechanisms are is important, because to me, then the policy response should be, we need to be making people's homes safer, right? We don't want you to have lower insurance and stay in an unsafe home. We want your home to be safe. So I think that's an important thing to try to unpack and understand a little bit. The other thing I'll flag, but I don't know anything about it, you'll have to find another guest, is that I do hear emerging conversations about whether bringing AI into insurance pricing is going to sort of accidentally, or we won't realize that it's bringing in some of these discriminatory factors that we probably wouldn't be comfortable with being there.
Right, knowing that the data from which they're going to draw is built into some models based on past regulations or other things, or the way that numerical or language is picked up and producing some results or some suggestions that are less than optimal. Um, One last thing, you've done a fair amount of work or knowledgeable about Miami-Dade, Florida, using that as an example, which if people were to look at a place that seems vulnerable, just like Louisiana coastline does, where New Orleans is, and or that we saw the fire risk in California. When you take a place like Miami-Dade, which we're still building to this day at a very rapid pace, and yet it's really literally on the tip of climate change. Um, they've done a lot of looking at what the risk and pool, not the risk challenges are there. Tell us about, through the forums that they held, what they determined they should be doing.
Yeah, they held some really interesting conversations with different sectors around these issues of insurance and insurability and how we close insurance gaps for
Hmm.
certain types of risks or populations that we don't have good insurance coverage for. And I think a number of interesting things came out about, potential solutions, maybe changes in state policy, areas for investment, like we were just talking about, and loss reduction that could help stabilize insurance market outcomes. But I think these conversations also point to the most difficult conversation I think communities in your region and in other places are struggling with, which is, it is just our climate reality that there
Hmm.
are going to be places that are no longer going to be economic to continue living in,
Right.
especially in the face of sea level rise. And that's a hard thing for any community to come face to face with. And I don't think there's few political leaders out there who get, points for saying that there's places that we shouldn't be building. But I think we're going to have to start grappling with both. How can we put in place better restrictions to prevent new development
Hmm.
in areas that are going to be incredibly vulnerable and uneconomic to continue habitating in the future, so that we don't make the problem worse? And then how do we unbuild? And that's really hard.
Oh, yeah. But I think what you just said is why I volunteered at the beginning of this conversation. Sometimes people hope that insurance will save us from ourselves. You mentioned it's really hard for a politician to say, well, we probably shouldn't be living there. But if he or she says that, probably not going to get reelected. I'll let the insurance companies tell you that, because they're doing it purely on a business basis, not on a political basis. And I think that's why people are looking. I'm so interested in insurance as a reliable source of decision making based on things that are quantifiable. But as
I
you point out, that may not be the right way to think about
No,
it.
I think that's true. And there's a lot of economic truth to that, right? I mean, if you're pricing based on risk and you should see benefits for lowering that risk or living somewhere safer, that should be a real information signal and financial incentive
Mm-hmm.
to move to safety or invest in loss reduction. I think there's a few challenges in making that signal stronger or work
Mm-hmm.
more quickly or effectively. One is that insurance only prices for this year's risk. And so
Yeah.
we don't have good communication or pricing signals that like, hey, it's maybe manageable for you today, but 10 years from now, it might start to not be. And I think we need to figure out how to communicate about increasing risk because you see these homeowners who are just shocked by the price
Yeah.
increases. But really, if you had been looking at the risk models, that was writing on the wall, right? And so, but nobody's telling them. So I think that's one challenge. The other challenge is just our politics because what we've seen is pockets that the private sector has said are uninsurable. They are not offering policies, but
Mm-hmm.
you can buy it from your state back program. Right. And so I
Mm.
think we struggle with these political questions of when insurance is going to pull out, should we keep offering it? Should we
Yeah.
keep offering it cheaply? When do
Yeah.
we stop offering it? Who do
Right.
we offer it to? And those are hard conversations we're only just beginning to have.
Yeah, and the element of time. Well, we're looking
Yes.
at 1 year basis, but you should be looking at 10, 20. Which if we're building cities, civilizations, we've got to be looking
Looking
more
longer term.
broadly. Yeah, I mean, but it's really
Yes.
hard. We're inclined not to. We think that
Yes.
tomorrow is going to be pretty much like today, and that may be true. But we're seeing the rate of change, and that's where I think the Louisiana coastline is so instructive. People are witnessing the change in real time,
Yeah.
on not a daily basis, but close to it.
Yeah, I mean, we are in a period of rapidly escalating risk, and I think that is
Yeah,
very hard for people to get their minds around the
yeah,
implications of that
yeah,
because we're used to kind of more stationary systems.
yeah.
I heard someone say this and it really stuck with me, which was, it was the hottest year on record, it was the hottest month on record. It's probably one of the coolest your kids are going to experience.
Right.
And that kind of just change in frame kind of wakes you up a little bit because we're constantly hear the record breaking, right? Yeah, it's the warmest, but like, wow, we are really locked in now.
That's right.
And that requires a different way of thinking. Yeah.
And that's what we are trying to do is bring that level of awareness to people, the long run, and thus try to make decisions by what we buy, the things that we do, who we put into public office, the companies that we work for, that reflect an awareness of what is going to happen. As we say, and Jeff Goodell's reminded us, it's never going to get cooler. Therefore, knowing that, and by the way, you knew a hurricane was going to hit New Orleans like that and will again. So, how have we prepared for that, knowing that those things are true? So, ending on, let's hope, a good note for insurance for good, as you look forward, what is going to be your focus? What do you hope to achieve in the coming years or more, since we asked to think longer term?
Yeah. I mean, I think along a number of different metrics, we hope to be a source of trusted information for communities around the country to get their heads around insurance, but also where insurance fits in these broader risk management conversations we just had together, right? And how do you make it a piece of this bigger puzzle of managing your risks going forward? Because that's when it's most impactful. Not when you
Mm-hmm.
think about insurance in isolation, but when you think about it as part of all the communication and risk reduction and everything else that needs to be done. And then we're also helping to, on the two other things I talked about. One is think about what these new models look like. We talked about some
Mm-hmm.
of them, test them out. It turns out we learned that you learn a lot from testing that you don't learn just from thinking about it or from the book research, right?
Mm-hmm.
So that we can figure out what actually works on the ground for
Right.
what populations, what jurisdictions, and then scale that. And then how do we create the policy and regulatory frameworks for insurance to be a source of good, that it can be? And that does require the right policy and institutional structures as well.
I can imagine trying to test things in real time, in real places, with real people. People do that with regard to their health. If there's something that's a drug or something that's being tested that might help them, people often say, "Yeah, I'll try that. It's in my interest to do that." But getting communities to do it, and then if it doesn't go quite as predicted, or maybe in their favor, saying you don't want to lose the faith of people to allow us
Right.
to innovate and try to find the right solution. So that's an interesting experiment that you suggested.
It is, it's tough. And I think it's also about the language and how you frame it, right? To what you were just saying, that this is testing and learning. And if it doesn't work out, the learning is still really critical, because I find this especially true in the insurance innovation space. It is just as important to identify what doesn't work as what does. So we can stop wasting time and resources on stuff that's not going to be impactful or is not going to scale, and pivot to where we can make a difference. But it's sometimes that's a mind shift that's hard.
I'm the community that wants you to test the things that you know are going to work, if that's okay.
Yeah, exactly. That's great.
Carolyn, you are so knowledgeable about a really complicated topic and all the vectors that intersect insurance. We thank you so much for your time today and your insights, and hope this isn't the last time we speak to you, because I think, as you point out, insurance is becoming interesting to a lot of people, surprisingly so, but it's such a good descriptor of our future. So thank you for sharing all of your thoughts.
Thank you so much for having me on. This was a great conversation.